Today, we're diving straight into the financial engine behind Dave Inc., traded under the ticker symbol DAVE.
Right off the bat, Dave is not your traditional brick-and-mortar bank. They operate as a highly efficient, digital-first, AI-driven neobank. Their absolute core mission? Protecting financially vulnerable U.S. consumers from the crushing weight of predatory overdraft fees and payday loans. They actually do this by funneling users in through a product called ExtraCash, which provides short-term cash advances up to $500, and then seamlessly integrating those users into Dave Checking, AI budgeting tools, and even a gig economy job board. They monetize this entire ecosystem through origination and express delivery fees on those advances, a flat $3 monthly subscription fee, and interchange revenues from the Dave debit card.
And the scale of this opportunity? It's staggering. Management estimates a total addressable market of 185 million U.S. consumers. To put that into perspective, that is over half the country. We're talking about people who are underbanked, living paycheck to paycheck, and desperately needing micro-liquidity just to bridge the gap between their bills and their paydays.
So you might be wondering, how exactly do they serve a demographic that traditional banks actively run away from? Well, that brings us to their economic moat, CashAI. Think about this for a second. The FICO score was created way back in 1989. Relying on it for instant microlending today is essentially like using a rotary phone to send a text message. Dave completely ditches that outdated backward-looking model. Instead, they use a proprietary machine learning engine that analyzes hundreds of millions of user transactions in real time. It evaluates cash flow, deposit consistency, and spending behavior to make instant, hyper-accurate lending decisions. But the crucial question is always, does this AI actually work in the real world? Well, in the first quarter of 2026, Dave's 28-day past due rate was a microscopic 1.69%. In the world of short-term, subprime lending, a default rate that low is practically unheard of. Most legacy players wouldn't even dream of touching these consumers because of the credit risk. But this metric absolutely proves that CashAI can safely scale origination volumes without blowing up the risk profile, handing them a massive competitive advantage over those legacy lenders.
And this technological moat is directly fueling a financial explosion. Dave has successfully evolved from an unprofitable hypergrowth SPAC into an absolute revenue machine. Fiscal year 24 revenues sat at $347.1 million. Fast forward just 1 year to fiscal year 25, and that surged a massive 60% to $554.2 million. But look, top-line growth means absolutely nothing if it doesn't translate to profits, right? That's why a 162% explosion in adjusted EBITDA for fiscal year 25 is the real headline here. Hitting $226.7 million shows immense operating leverage. Just as a quick refresher, operating leverage simply means that as Dave scales its user base, its fixed corporate costs stay relatively flat while the revenue just keeps climbing. Because of that dynamic, a huge portion of every new dollar they make falls straight to the bottom line as pure profit.
That level of profitability is deeply rooted in industry-leading unit economics. On one side of the equation, they boast a record-high net monetization rate of 5.1% as of Q1 2026, which is actually their highest in over 4 years. On the other side, they have a hyper-efficient customer acquisition cost of just $18. Think about that. When you can acquire a user for under $20 and monetize them at a 5% clip on high-velocity, repetitive transactions, you essentially have a license to print money.
So if the engine is running this hot, why did the stock pull back after Q2 earnings in August? Let's look under the hood. While revenue was incredibly strong at $170.8 million, up 30% year over year, they reported an EPS miss of 49 cents against highly elevated estimates of $3.44. But context is everything here. This miss was largely driven by a mechanical provision build. In plain English, accounting rules forced them to set aside cash reserves purely because their outstanding loan balances grew so rapidly at the very end of the quarter. In reality, if you look at the core business, underlying adjusted EBITDA actually climbed an impressive 48% to $69.3 million. The underlying machine is literally more profitable than ever.
And management isn't just coasting here. They are aggressively setting up the future. The Coastal Community Bank Partnership, which became effective in June 2026, is a massive catalyst for us to talk about. By transitioning ExtraCash receivables off its own balance sheet, Dave secures the holy grail for a fintech. They significantly de-risk their operations and heavily reduce their direct funding costs. Even more importantly, this deal unlocks over $200 million in fresh liquidity. That is pure dry powder ready to be deployed directly into massive marketing campaigns and share buybacks for the second half of the year.
Now, for anyone out there worried about corporate balance sheets in our current high-interest rate environment, pay close attention to this metric, an astronomical 50.1 times interest coverage ratio. While they do carry roughly $268 million in debt against $207.9 million in equity, they're generating over 50 times the cash needed to service that debt. Default risk under current macroeconomic conditions is, for all intents and purposes, virtually non-existent.
So how is Wall Street pricing all this execution? When compared to a well-known fintech peer like Upstart, investors are clearly paying a hefty premium for Dave on a price-to-sales basis, around 6 times compared to Upstart's 1.5 times. Why the massive gap? It all comes down to the bottom line. Dave operates with vastly superior EBITDA margins of roughly 44%, completely crushing Upstart's 13%. You see, Upstart relies on funding heavy, macro-sensitive personal loans that tend to freeze up when rates rise. Dave, on the other hand, relies on high-velocity, short-term micro-liquidity within a tight, highly controlled ecosystem. The market gladly pays a premium for that kind of efficiency. Pivoting over to the technicals for a moment, the stock sits right around $317.93 after a recent 12% pullback, which was triggered by that headline earnings miss we talked about and some broader market volatility. It's currently consolidating just below its 50-day simple moving average, but crucially, the long-term setup remains overwhelmingly bullish, sitting well above the 200-day average of $242. This post-earnings flush appears to have simply shaken out weak hands, presenting what looks like a highly attractive accumulation zone for savvy capital.
If you want to know how safe that floor really is, just look at who is holding the stock right now. You have massive institutional backing at 77.6%, which provides serious price stability. Add to that 18.1% insider ownership, led by CEO Jason Wilk, demonstrating massive skin in the game. Remember, their aggressive Q1 buybacks retired nearly 1 million shares. That acts as a synthetic insider buy, shrinking the overall float and further concentrating the wealth of existing long-term shareholders.
So, where does the growth engine go from here? There are 3 massive catalysts locked and loaded. First up is Dave Flex, their strategic entry into the buy now, pay later space. This allows users to finance larger purchases using the existing CashAI underwriting, which is guaranteed to drive significantly higher average revenue per user. Second is the rollout of CashAI version 6.0, refining those predictive models to safely offer larger credit limits for prime users. And third is actually deploying that $200 million in bank liquidity to massively scale their marketing in the back half of the year, driving a huge influx of new monthly transacting members.
Of course, no investment is without friction, and there are 3 primary red flags we need to monitor here. First, subprime vulnerability. Dave inherently serves a financially stressed demographic. A severe macroeconomic recession with spiking unemployment could rapidly degrade CashAI's predictive models. Second is regulatory scrutiny. The CFPB is constantly putting overdraft fees and tipping models under the microscope, which could eventually compress Dave's monetization rate. Lastly, as we just saw in Q2, the mechanical nature of their provisioning accounting will likely continue to create lumpy gap earnings that can temporarily spook the market.
Weighing those factors gives us 2 very distinct scenarios. The bear case envisions a severe recession where charge-offs spike above 3%, wiping out gross margins, and the stock plummets to test that 200-day moving average at $242. Conversely, the bull case sees Dave Flex catching fire and marketing spend yielding rapid paybacks. If sustained margin expansion continues and they hit their $730 million revenue guidance, this stock could easily push toward the high-end analyst target of $490. Right now, management's flawless execution heavily skews the risk-reward ratio in favor of the bulls.
To really summarize the core thesis of this explainer, there's a quote from the research that perfectly captures the narrative. Dave is, quote, a rare breed in modern fintech, a hyper-growth tech company that pairs 30% top-line growth with aggressive GAAP profitability and active share repurchases. The recent pullback into the low 300s is fundamentally an accounting anomaly, not a sign of underlying credit deterioration.
As we wrap up this explainer, I want to look a bit beyond just the price action. Analysts currently place a base target of $450 on the stock, implying roughly 40% upside from here. But zooming out, given their hyper-efficient unit economics and a massive addressable market, is Dave's